Hello, everybody. I am Joy Bailey. I am the mortgage boss. And today I wanted to fulfill my promise from last week. I said I would have another mortgage boss talk Tuesday. I'm going to try to stick with this Tuesday day, and we're going to see how it goes. I'm here to answer your questions again. Everything you want to know about home buying or any questions that you may have regarding, what my career is like as a loan officer, because I always get questions like that from people. And so I just wanted to open up this platform so that I'm able to answer that for you. I was on my Instagram page. So for those of you that do not follow my IG, it is the underscore mortgage underscore boss, BAWSE on IG. I asked people to just give me their questions. So I will have some questions to be able to answer for you. And so I do have a few here. And so I want to keep this limited to about an hour. And so hopefully I'll be able to answer, some of the questions that other people might have. So we'll see how long this takes. But y'all, before I get into that, it was an interesting day today. Those of you that follow the news may have heard that Jerome Powell, who is the Fed chair, him along with the committee, they are responsible for raising rates, lowering rates, just really doing kind of like a temperature check on the economy and making adjustments so that things are balanced and so that we're not going into a depression, or honestly want to regulate it so things are not too good either. And so I do have an article I'm going to try to pull up, and I want y'all to see this. Now, about a month ago, interest rates were lower. Interest rates were about, I don't know, like almost a percentage point lower, if I'm going to be all the way honest with you. And now, based on the jobs report and some other things, we seem to have done a little bit too well. So for those of you that are interested in having lower interest rates, please understand what you are asking for is you want, like literally you're rooting for people to be laid off their jobs. So the plan was last year, which was in 2022, to, get the rates going up, and then start to slow it down, which is why I think in December, instead of going up, 0.75, they slowed it down a little bit. And so now he's saying, you know what? That wasn't good enough. You all took advantage of my kindness. Y'all out here balling out. Y'all buying these cars. Y'all running up these credit cards. Y'all going on vacation. Y'all just living y'all best lives. And y'all out here finding money, finding ways to spend it. And I don't like it. So here's where we are as of earlier today, based on some of the remarks that he made. So let's kind of go through this Wall Street Journal article really quickly before I jump into my questions. So Jerome Powell says that the Fed is prepared to speed up interest rate rises. That means get ready. So again, understand that interest rates, when they set interest rates, right? So if let's say it's at a 4.5, whatever it is now, that doesn't mean that the interest rate for a mortgage is going to be that. We have to add in some other factors and things, and that's how we get to the interest rate that we pass on to you as a consumer. These rates are based upon what it costs the bank to borrow the money. So when people start getting into, oh, what's your interest rate? I'm like, we all get our money from the same place. And this is where we are borrowing. So look at this. Jerome Powell said that the Federal Reserve would consider raising interest rates by a larger 0.5 percentage point this month, Y'all, it is March the 7th. So this month, he's likely to lift rates higher than previously expected this year to cool an economy that has shown surprising strength. I'm a little bit concerned about this because I remember, I don't know if y'all ever saw that movie. Oh my God, why can't I think of the name of the movie? It was about the mortgages. Oh my God, it's on the tip of my tongue. Not The Wolf of Wall Street. Oh my God, what is the name of that movie? The Big Short. The Big Short, the entire movie based on, real life events during the crash in 2008. It kept repeating this theme of, oh my gosh, like, why are things going well? Housing should start collapsing. What is going on? Why is it taking so long? And so when I see that they're saying it's showing surprising strength, it does make me feel a little like, I don't know. I'm speculating it's probably because a lot of the side hustles that people have going on and money that they're running off the books is not taxable. But, that's just my personal speculation, just based off of conversations that I have with people as it pertains to their finances. Anyway, so he said earlier today that he's laying the groundwork for a notable shift in tactics to reduce price pressures. He said hotter inflation and hiring could lead the central bank officials to alter their recently adopted strategy of raising rates in smaller quarter point increments. So that means, okay, we tried to pull back. We thought the numbers were headed where we wanted it to. We're still in super high inflation. And just in case you all don't, really understand how inflation is, it's based on supply and demand. He can't make more widgets. The Fed can't make more houses. He can't make more microchips and things that go in vehicles. So he has to say, you know what? Maybe we can make it so expensive that people will start to not want to spend as much money. I low-key kind of feel like, it's 3 years after COVID. I think these companies are just raising prices like because they want to. A lot of these manufacturers, they're like, oh, this is great. The good times are rolling and it's up and it's stuck, which is very concerning because regardless of the price, apparently we as consumers are continuing to buy things. So the latest economic data has come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. So I'm going to stop here because the rest of it gets kind of into the weeds of things that I do not talk about. I strictly talk about housing. I don't get into all of those other things. What does this mean to you? I looked up the interest rates. We are at a national mortgage rate roughly of about 7%. So we are over the 7% mark. And when they look at this, if you contact a mortgage lender, they're probably going to quote something higher than this. So if you're actively shopping for a home loan, please do not say, oh, well, I saw it was 7%. It is and it's not, because obviously mortgage lenders are trying to run a profitable business. And so we have to add in things to make sure that we're able to cover things like our technology. We're going to add in money to pay our employees. We're going to add in some money to just, again, pay for the buildings and all of the expenses related to running a mortgage business. And, have a little something on the side as well. So most likely, if you are someone that is getting a 30-year mortgage and you have a FICO score, let's call it 740, 760, like a really high FICO score, and you're putting down 5%, you are most likely going to see this somewhere around 7.375, 7.5, something like that. And that is not paying any points. It could be higher. Every lender is a little bit different, plus or minus some of the things that I mentioned earlier in terms of how much they would like their margins to be in terms of profit. So we over 7%, y'all. houses are expensive. And you can see here, there was a dip, 6.43 only a couple of weeks ago, 6.36 a month ago on 2/3/23. And now we are up almost a full percentage point. So that is where we are with our economy right now, y'all. And here's the problem, and I cannot stress this enough. People buying things, it is what is fueling this fire. Because people are buying things, companies feel that they need to continue to hire more employees. Consequently, it's a vicious cycle of, hey, we need more employees because people are buying stuff. We need to get more employees, so we're going to spend money and right? If people stop spending, companies are going to have to lay off. If companies have to lay off, those people are going to have to file unemployment. They're not going to have money to spend on vehicles and all of the other things. I didn't pull this article that I'm about to mention, but I have seen stats that have supported people are starting to fall behind on car payments. And if you know anything about car payments, y'all, these car payments are starting to be in excess of $1,000 a month. And it is, again, tied directly to these interest rates. So it costs us money to borrow money, and we pass that charge on to you as consumers. So the longer you are spending money on credit cards to go on vacations, the longer you are spending money on 84-month auto financing at 10, 12, 14, 18% interest rates, it's going to continue. And I don't know. I don't know where it's going to end. I'm not sure because, again, I am not an economist. I'm just telling you what the streets are saying. I'm telling you what I heard directly from the source. So my advice would be slow down your spending. And as you've noticed, your interest rates are higher on your credit cards. So again, they're repurposing or reallocating the extra dollars that you would have had to go towards debt. And it is starting to become insurmountable because people want to continue the lives that they had 2-3 years ago when the good times were rolling during COVID. And so, I mean, I get it. I preach and I talk about, real estate advice for real people in real life. And I be going through real life myself. So I'm not throwing stones. I'm just explaining why things are the way that they are. So, all right. You guys, look, let's look in the chat and see who we got here. All right. Hi, Terrell. How are you? Thank you so much for joining me. I appreciate your support. Terrell is in, y'all, I'm in a YouTube mastermind. So in the YouTube mastermind, we talk about, how to make sure that we're serving the audience in the right manner. And we're talking about relevant topics and things that's going to get us the views that we want and grow our channels. He is in education in St. Louis, I think. And so he talks a lot about current events and things as it relates to the kids, because we love the kids with a bad, but I'm a censor. I used to teach schools, so I already know. I know what's up over there. So thank you for stopping by, Terrell. Hi, Jonathan. Jonathan Miles says, what's up, everyone? What's up, Jonathan? How are you today? He says, I was watching Orlando Miner's channel and he predicted this would happen. It's crazy. It's basic economics. What goes up must come down. Now, it is not going to be a crash as far as real estate or anything is concerned, but we just have some major supply and demand issues because things stayed so low for so long. And now, I mean, one of the things that I always heard when I was growing up is like, in life, you're going to pay on the front end or the back end. If you choose to pay on the back end, you're going to pay with interest. And that's literal in this particular situation. So for those of us that did not pay in cash to purchase cars, because I sure didn't. I'm leasing my Acura. And I'm scared because my lease is going to be up next April. So I'm going to need them to get this straightened out before I have to turn my car in and have to have a higher payment for a lesser car. Because what I'm not going to have, unless, y'all start making me a lot of money on this YouTube channel, is $1,000 payment. That's what she's not going to do. Okay. Yes, Crystal, there is that. The Big Short. The Big Short. I was struggling with that. You know how you have something on the tip of your tongue? It's like, I can't. And it's my age too. I think, things don't be coming the way it's supposed to. So thank you, Terrell. I appreciate you. Thank you, thank you, thank you. All right, y'all. So let me get into my questions. I had a few, so I'll run through them as quickly as I can. And if you all have any questions that you're thinking of, comments, whatever, please, please, please put them in the comments, and I'm happy to chat with you. Okay. So this person asked, as a first-time home buyer, should I put down 3% or 20% to avoid PMI? So PMI is private mortgage insurance, and it is associated with a conventional loan. The purpose of PMI is actually to help you. It's not there to hurt you. And a lot of people think it's like a cuss word, like, oh, my PMI, I don't want to pay PMIs, and it's a good and a bad thing, right? I personally would never be able to save up 20% on a $450,000 house. And I want to also address that, y'all, again, because we're going through real life over here. I'm not going to use extreme examples, really low or really high. We're going to kind of stick with whatever the national average is so that everybody has a general idea of what is going on. So I wouldn't, like, that's what is that, 80, 90, $90,000? That's too much money. I would never save that. And so because I know I would never save that, PMI would be my friend. It is significantly easier to put down, $10,000, $12,000, $15,000, especially if you have assets that you've saved up in a checking or savings account, or in some cases a 401k, to be able to get into the home. The question basically saying which one to avoid the PMI. My thing is, what are you losing? At what cost is it to put down this 20%? Most likely, you're not going to save 20% in the span of 12 months. It may take you 5-6 years to do that. The thing is with PMI, if you put down the 3% that's required if you are a first-time home buyer for a conventional loan, or even 5% down if this is your second time purchasing a home. If you have good credit, and let's see, how do I define good credit? Let's call it above 700. You're not going to have, $500, $600, $700, $800 a month in private mortgage insurance. It'll be a few dollars. I'll give you an example. I was pricing out a loan earlier today for someone, and they wanted a conventional loan. They purchased in the past, so it's 5% down. $450,000 is the number we talked about. And really, really good credit. It was like 780, 800, really high credit. The mortgage insurance on the $450,000 home was only a little over $100 a month. So is that $100 a month you're saving, which is what, $1,200 a year, $1,300 a year? Would you forego the equity of getting, 3, 4, 5%, which is average price appreciation year over year? Would you rather forego that to save $1,200? I don't know. It's a personal choice. There's not a right answer. There's not a wrong answer. But why is it so important to avoid the PMI? Like, what specifically is it? I mean, because I personally don't feel like, $100, $200 a month it shouldn't make or break your decision in terms of like purchasing a home. But everybody's scenario is a little bit different. So, PMI is only there to bridge the gap to allow you to attain home ownership faster and be able to participate in wealth building a lot faster. Yeah, crash or correction. His channel is too funny. Do a collab. I think that's what you call it. Yes, it's a collab. I follow Orlando actually, so I might take you up on it. Go drop my name in his comments. Let him know that the mortgage boss is coming. Okay. Let him know. Let him know who I am. He has a big channel. I got like 600 people. He has what, 25, 30,000 people, maybe more than that. I follow him and JT. I know the two of them, they do a lot of collaborations together as well. So, but yes, he's super, super smart, super, super thorough. Yeah, I might have to reach out to him on that. That's not a bad idea at all, actually. Thank you, Jonathan. All right. So next is, why does DPA penalize applicants with higher rates? So DPA is down payment assistance. And y'all, okay, if you watch my channel, down payment assistance has its place. Unfortunately, I think that it is being hyped up. I don't want to say that. I just gotta say, y'all being lied to. Okay, people are being sold a bunch of lies, a bag of goods, if you will. Down payment assistance is not free money. Like I hint at, I don't talk a lot about down payment assistance because I don't want these ideals to be, oh well, it's free money, anybody can get it. It's not your birthright. It isn't anything that you're entitled to just because you merely exist as a citizen in America. In fact, it is quite the opposite. And so yes, down payment assistance comes with a few things. So it comes in two forms. It can either be a grant, which is somewhat technically free money. Just like when you went to college, you might have qualified for like a Pell Grant or something like that. It's forgiven. You don't have to pay it back. Or it can be a loan. More often than not, those are called forgivable loans that are silent seconds. Meaning, if you fulfill whatever the obligations are that this second loan, we call it community second loan, asks you to fulfill, it will be forgiven. But let's talk about that journey to forgiveness, shall we? So, one, down payment assistance is most likely going to come with a higher interest rate. Now, I just showed you about 10 minutes ago, the interest rate's at 7%. So imagine having an interest rate at 8% because you want free money. That free money at 8% is going to have to be paid on for 5 years potentially before they forgive it, 10 years before they forgive it. It might be 15 years before they forgive it. It could even be 30 years. It's whatever the people tell you. What happens is, along the way, I just told you now, so you got 7% as the market rate. Yours is 8% because you wanted this free $8,000, right? Or it's usually not a whole lot. The reason why the rates are higher is because they're pricing in the risk that you don't have your own skin in the game. You are more likely to default on the loan because you haven't really put anything in, if that makes sense. So they're getting their money, which is why I'm like, it's free money. It's not. It's an advance. It's, it's just it isn't free money. But it is gonna usually, not always, be at a higher interest rate because they want to get their money back. The other part of it is you're gonna be required to keep it for a particular amount of time, even if it wasn't at a higher rate. Okay. When I say it might be forgiven after 5 years, 10 years, 15 years, what that translates to is, okay, so interest rates are going up right now at this time. So let's call it 7%. That rate is 8%. Well, guess what? If we wake up in 6 months, let's say you close on your house today and you got your free money, and say 6 months from now, interest rates, you wake up, interest rates are in the 5s, interest rates are in the 4s. You're gonna be like, oh shoot, I want that. I want that money. I gotta get it. What I want to refinance. Pump your brakes. When you have down payment assistance, you're usually going to have to repay those funds out of the equity that you've accumulated or out of your pocket before you can refinance at a lower rate. Okay. So it ain't free money. And the rates are higher because of exactly what I said. They're pricing in the risk that you've not put anything in to basically make them feel more comfortable with lending you, $200, $300, $400,000. Or whatever the amount is. Here in North Carolina, the North Carolina Housing Finance Agency will allow you to go up to $385,000 as a purchase price. Quite often, I do see advertisements, colleagues, people on social media, they'll find a program and they'll be like, oh, you can get $30,000, $40,000, $50,000. I had someone a couple weeks ago send me something that they found, and it was like, "Oh, you get $80,000." She's like, "Well, can I get this?" And baby, oh, you'll never get out of that. Like, do you know how long it's gonna take for somebody to accrue $80,000 in equity? The idea of home ownership is so that you are building wealth, not having to repay and owe somebody some money. So even if you stayed in the house for 5 years and over 5 years you got $80,000 in equity, you still at zero, because if you have to pay that money back and then you're moving with no equity. You're not getting any benefit, anything out of it. So that's that. Terrell say it. I try to couch my words, but y'all know I have to be honest, because I don't want people to be misled, and y'all have no idea how hard it is. I be over here fighting for my life on these internet. Okay. It is people that have channels dedicated to creating a frenzy, providing inflammatory headlines without appropriate context. They'll say things like, "Oh, foreclosures are up 120%." Yeah, from zero. Like, let's, I have to just be honest. And I don't think that it's okay to mislead people. I feel really uncomfortable with doing that. So I try to give all perspectives on the issue. And I'm gonna be honest with you, sometimes I talk myself out of a sale because I want to make sure that whoever I'm talking to and I'm educating, they have the full picture, because I do not want anybody to come back and say, "Well, Joy, you didn't tell me." Yes, I did. I told you. I said it. And whenever I talk about down payment assistance with my borrowers, when they do it, because like I said, it definitely has a place. I just make sure that when we get off the phone, I hang up, I send an email, and in red lettering that is italicized, underlined, and highlighted in yellow, they know exactly what it is that they're signing up for. Johnson said, who's selling lies? A lot of people on the internet. A lot of people, at the end of the day, this is a job. And so you have to always consider what is the ultimate goal. Why am I talking to y'all right now? Like, I'm at work. Like, this is my job, right? My goal is to provide solid enough information where people begin to trust me. And I set myself apart from all of the people that's creating frenzies and people want to do business with me. Everything else comes secondarily to that. Whether or not my YouTube channel is monetized or not. A lot of what I see on Instagram, unfortunately, when they start talking about, oh, get $40,000-$60,000 in down payment, it is presented in a way that people are being targeted, almost specific audiences that are a little easier to take advantage of, and I don't like that. So those are the lies that I'm talking about. People that have alternative motives. Someone says, how long does it take to buy a home? It completely depends. The most ideal time is probably about 90 days, because after that, documents and things start to expire. Mortgage loan officers' jobs are to process loan applications, lock your rate, give you quotes, kind of package it and say, hey, this is about how much money you'll need to bring to closing. We will assess your current finances to see how much money you currently have in the bank, kind of walk with you through whatever your ultimate goals are. And from there, we'll be able to set you up for success, whether that's, a $600,000 house or, $300,000 house, or what have you. Sometimes what will happen is loan officers are newly being advertised as free credit repair. I have seen quite a few postings from people that are not loan officers saying, oh, all you got to do is just call a loan officer. It's like free credit repair. It is not. For those cases where we might look at your credit report and say, hey, you can tweak some things here or there, that is not considered credit repair. We're just making observations. Loan officers, in most cases, are not qualified to do credit repair. So it can take you a year, 2 years, depending upon what your situation is. But in most cases, it takes about 90 days. So to get pre-approved, it's about a 30-minute long conversation, depending upon how much research you've done on your own. Complete the loan application, you submit your loan documents, I'll review them. I'll say, okay, this is our game plan to meet your goal, because loans are customizable depending upon the person that they're for and what the end goal is. And then you'll get a pre-approval letter. You'll take your pre-approval letter to your realtor. You and your realtor will look at a couple of houses. I've been hearing people are looking at 20, 30, 40 houses. Honestly, all these houses look alike. I don't know what people looking at to take 40 houses, but whatever. Everybody's different, I guess. But honestly, after looking maybe 5, 6 houses, maybe different parts of town, you submit your offer, and from there it could take up to 30 days to be able to go through the full process of underwriting, getting the appraisal order, the title cleared, and getting to the closing table. So, I mean, just a couple months is about how long it should take. But again, everybody's situation is a little bit different. For me, I was a loan officer when I bought my house. Oh my God, y'all. And I tell this all the time. I was awful. I was horrible. I was everything that I tell people to not be. I did everything that I tell people to not do. I was a disaster. I really was. But I got there. It took a while because I needed to get my credit score together. So when I started the process, or when I got the idea, my life was falling apart. Well, no, it was after my life fell apart. My credit score, I think, went from like a 493 to in the 600s before I purchased my home. And it took about it probably took 2 years. Seriously, it probably took 2 years. So whenever I hear people like, "Oh, I'll just get my credit fixed," like, okay, I'll talk to you in a couple of years. Because it does take time, a lot of time. And really, it probably should have taken me longer than that. But I was able to leverage some things to get my credit score up a little bit faster. So it worked out in the end. Oh, a loan officer question. Okay. So do you think that it's worth it becoming a loan officer now? Yes, I do. Oh, excuse me. I do. I love being a loan officer. I think it is worth getting into the industry now as long as you think it's for the purpose of a career and not like some sort of like get rich quick, I'm gonna get some money, type thing. Like you can make money, it's great, but you have to consider the long haul because, as I stated earlier, what goes up must come down. The interest rates are going to come down. And if you can get in and kind of get your footing established and you learn the jargon, you learn the loan products, when people start to refinance, you are going to feast. It cycles. But if you start looking around and it's like, oh, everybody's making money, I'm going to go and do it now. You're too late. You're already behind the 8 ball. So yes, I think now is a good time. It's always a good time. People are going to get mortgage loans now and forevermore. How long is the pre-approval good for? Generally 90 days. The pre-approval is going to be good for about 90 days because the credit report expires. Your asset statements, they expire. Your pay stubs and things, all of that stuff, it has expiration dates. So if you were someone that qualified a year ago when the interest rates were, 4%, we can't use that now because you're going to qualify for significantly less today unless your income went up, substantially. So yes, 90 days. And really in a rising rate environment, you want to make sure you're refreshing that every couple of weeks. If you are at a place where your debt to income ratio is already kissing the line. I had someone that reached out to me in January. I'd spoken with this person a year ago. She said, "Okay, I'm ready. I'm ready. I'm moving. I'm gonna get this house. I want to. I think I'm okay. Let's try for. I think it was like two. She said, "Oh, I think I could find something for 230. Not in Atlanta, Georgia. You can't. So I ended up qualifying. I think for like 265. Okay. She's looking. I started noticing the interest rates were going up. I proactively went ahead without even talking to her, and I politely sent her and her realtor an updated pre-approval letter. She lost about $20,000 in buying power because her debt ratio was at like 54% and 55, 56 is the max that you can do. And so she politely responded to me, "I think I'm going to wait." So you want to, refresh your pre-approval letter every so often especially in a rising rate environment. If interest rates were falling, I would recommend the same thing, because if interest rates are going down, then it's a chance that you may qualify for even more house. So that's how long it's good for, about 90 days. What is a conditional approval? So the underwriter usually touches the loan file twice. So the first time is, hey, let me look at this and make sure everything is the way it's supposed to be. I'm going to look at your income. Okay, that's there. All right, I'm calculating, and when I say calculate, if there is an Excel spreadsheet, and this is public information, if you Google this, most often, like companies like Radian, MGIC, any mortgage insurance company, it's public information. They'll put in any overtime, bonus income, all of this, and so they'll average it and they'll say, okay, you might make, I don't know, $7,526 a month. Okay, well, now that we got that, we may have seen, or the underwriter may have some questions about a bonus that you got. Maybe on the pay stub, it doesn't clearly say it's a bonus. It may say incentive. Well, what you mean incentive? What does that mean? Let's get some details around that. And so they'll do the math. They'll say, okay, everything looks good here, but we have some follow-up questions. So they'll issue you an approval. Hey, you're good to go. Go purchase your $450,000 home. Here's your conditional approval pending. Okay, this is yours to get as long as you get me back a letter from your employer saying that you can work from home, saying hey, get a letter stating that this income is bonus and not just a one-time incentive. Hey, I'm trying to think of like real examples that I've seen. Hey, get us a copy of your insurance policy, showing, reflecting, X amount in coverage or whatever. So that's a conditional approval. So you are approved pending you fulfill these requirements, so that we can tie everything up in a nice, neat bow. That conditional approval means that you as a borrower may have things to go and get. Us as a lender, we may have things to do in the background as well. It may be that you submitted such a clean file, there's nothing for you to do. And so all the conditions are on us internally. Get something from the title company. That's not for you to do. That's for us. That's why you pay, $1,200, $1,500, $2,000 to have us do all of the legwork for you. So a conditional approval is a loan that is approved pending we fill in the blanks, get some additional details about a few things, and allow the loan to go to closing. That's a good question. And then, once they've cleared the conditions, you may hear clearing the conditions. Once those conditions are cleared, then the underwriter will issue what is called a CTC, or a cleared to close. All right. What do you think will be done to get investors to start buying homes so that the market will become more regular? I don't know. We don't have enough houses. Homes are going to have to be built. And I think that to get builders to want to build more homes, they need to be incentivized. Y'all know this is America. We love money. They need to be incentivized with building more homes, be incentivized with building lower priced properties. The government is going to have to step in and do something, because right now, if you have a 2.5, 3.5, 4.5, 5% interest rate, where you going? Where you moving to? Why you moving? Your house is double what it was 3 years ago at a lower rate. So you're not giving up your house unless, certain circumstances force you to, like a divorce, you're moving out of the state. And even if you move, you might be like, this is an investment property, I'm going to rent it out. So I don't know the answer. I don't know that there's a solution, but America is such a business friendly tax structure. I don't think they ever gonna do anything about it, but I don't have an answer. But I do know that something needs to be done because it's unfair to regular people. They call it Wall Street versus Main Street. Regular people are not able to go in and stroke a check for $400,000. They're usually not going to be able to buy 4 or 5 of them at the same time. And even if this foreclosure wave comes that everybody swears coming and they so ready for, all the banks are going to do, let's say, okay, on my street, right? Let's say it's 20 houses on my street. And let's just pretend, that 4 of them all have the same start. Let's say they all with Penny Mac, and 4 of them in the course of 12 months all go and they go into foreclosure, right? Which I want y'all to understand is a long process to get to a foreclosure. Y'all think they're gonna put a sign out and be like, hey, it's a foreclosure, regular people, come on, come get. No. What the bank is going to do is they are going to bundle the loans and they are going to walk them over. Hey, I got all these widgets, houses, loans. I'm willing to sell them to you, institutional investor, Wall Street. I'm willing to sell this to you. How much will you buy it from me for? And it might be that they take 5-10% loss to cut a good deal versus Joe Schmo, who's like, oh no, I want to get 50% off. I'm only gonna want to pay this much, half of it. That's not how it's gonna work. They're gonna bundle those loans and they're gonna sell them, and you'll never get a chance to touch them. So that's that. I don't know what they're gonna do. These investors, I'm sick of them personally. So I don't know how the market's gonna be more regular. They're just gonna have to build more houses because, like I said, right now there's a backlog that it's gonna take years and years and years and years to fulfill. And if you think about it, like there are a lot of regulations that are on building permits. There's a lot of regulations on clearing the land, and the Environmental Protection Act. It's all kind of layers upon layers upon layers of why Joy Bailey can't just go buy a couple of I'm sorry. There's a lot of reasons why Joy Bailey, can't just have my little company and go out and start digging in the land. It just is not a quick turnaround process. It takes years upon years upon years. So I can tell you now that there are plans here in Charlotte, because we have something called the 2040 plan, that there are home builders like Pulte, D.R. Horton. They got the land. They done had the land for 5, 10, 15 years. They might not build on it for another 5 years. And that's just to clear down the trees. So it is going to take a long time. The other thing is lumber shortage was a big thing. You can't grow a tree in a day or 2 or 5 months. It's a lot of reasons. So it's going to take quite a long time to get this sorted out. Okay, I got 2 more questions. So if y'all have any questions, let me know. All right. Hey, Tamika Monique TV. Thank you for joining. All right. So, this is good. Okay. Lady said, I want to help my son buy his first home. How do you think we should go about it? Oh my gosh, y'all. I love when parents that look like me help their kids that look like me buy their first property. The thing that we kind of get twisted when we start trying to throw around certain words like, oh, it's generational wealth. It ain't for you. The generational wealth is not for you. It's for the people to come behind you, to give them a boost, give them a start. So this is a great question because this happens every so often. And I will be very honest, it happens in other communities significantly more often than it happens in our community, the Black community. Um, I have it just I cannot even begin to articulate how big of a deal it is when parents say, hey, you know what? I'll help you by, you know, taking equity out of my house to give you money for your down payment. Or they'll jump on the loan because they have good credit. So they want to help, you know, boost the credit of their child or boost the income of the child so the child can afford uh, a $300,000 first time home. Because honestly, here in Charlotte, out the gate, you at 350. And I mean, that's not even an exaggeration. Like we don't have typical first time homes anymore. And so because the interest rates are what they are, a lot of times if you're fresh out of college, you know, 3 or 4 years, you probably not making $75,000, $90,000, $120,000. We're probably not there yet. And so a parent could get on the loan to help supplement the income. That's one way to do it. A parent could help a child by gifting funds for down payment. That's a way to do it. And it doesn't have to be 20%. It could just be, you know, they're gifting 3%, 3.5% for the initial down payment. Another way to help a child purchase a home, and I actually had this conversation with a realtor not that long ago, very successful realtor here in the area. And, you know, she was saying, like, oh God, like we got to do the 20% down and, you know, all of this. And she was selling her daughter her property. She has multiple properties. The mom and dad, they have several properties. And she wanted to have the daughter go ahead and get her real estate portfolio started. And so what she did was she gets on the phone, she said, Joy, oh my God, these rates. Like, I can't pay more than 5%. Like, we can't do it. Cannot, oh my God, what are we gonna do? And she goes through the whole thing and she describes, you know, what some of her concerns are. And she wanted to make sure that she kept her daughter's payment, you know, well below what the market was calling for at the time. And again, this woman has been in real estate for 20 years. I said, well, why don't you just give her a gift of equity? She said, well, what's that? What's a gift of equity? A gift of equity is a great way for a parent to help a child get into their first home, second home, any home. So I have a 14-year-old. So let's pretend for the sake of the conversation, let's say that my son is 23 years old and I've been in my house for 10 years and I'm ready to, you know, get him to a place where he can become a homeowner. Well, if I've been in my house for, you know, 10, 15 years, I probably have $200,000, $300,000 in equity, just based on the way the market has moved, you know, from when I bought my house. Okay. We're forecasting. Okay. We hoping this house gonna be worth, you know, $300,000, $400,000 more. But let's just say for the sake of art, that's what it is, right? My baby at 23 years old, straight out of North Carolina Agricultural and Technical State University, Aggie Fried. My baby might not be in a financial position to go out and write a check for, again, let's assume that the house is going to be $600,000 at that time. It's a lot of money. I don't care what the interest rate is. He might not be able to support a $4,000 a month payment. So his mother can say, you know what? I only owe $125,000 on my loan. baby, mommy will sell you the house and I will give you the difference between the $125,000 I owe and whatever that $600,000 value is. The mortgage payment is only going to be based off of the loan amount. So we're going to come to a meeting of the minds about, well, how much money do I want? Do I want any of that equity? I might decide, no, like I got to walk out of here with something like maybe, okay, let me bump it up. So I got $125,000 that I owe. I want $100,000. So now I'm going to give him the difference between the 225 and the 600,000 or whatever the value is at that time. So now my baby, who's only 23 years old, is able to reap the generational wealth that I have accumulated for him because I've been in the house for how many years, and I'm willing to pass that equity to him. And I think that it's really, really, really important for us to talk about that. Generational wealth ain't for you. It's not for you. It's for the people that come behind you to be able to reap benefits. Generation, y'all get it? Like, I'm a generation, my son is a generation, his kids are, you see what I'm saying? Like, it continues to go. And so those are some recommendations that I have to help you get your son, daughter, whatever, into their home, their first home. Because imagine being 23 years old, you got a apartment size mortgage payment, but you got $200,000 in equity just out the gate. That's a win. I don't know what else to call it. Like, that is a very, very big deal. And I think that's something that in our community we need to start thinking about. I could sell my house right now, and I could, if I sold my house, it would solve all my financial problems. My student loans could be paid for, any debt card I have, credit card, it could all be paid for. But it's kind of like, dang, like, is that really what I want? I don't know. It's a decision I waffle with over and over, back and forth. I could take all my equity and put it down and buy me another house, but how does that benefit him? How does that benefit the next generation? And it's something, like I said, I'm going back and forth. I don't know. Like, my son don't even clean his room, y'all. I would be very upset if he tore my house up, even though it would be his. But those are some great ways. So gifts of equity. If you currently own a property, you could pass that equity on to allow your child to purchase your home. You can, gift them money for the down payment. And I also want to make sure I clean this up. That gift of equity not only covers the down payment, but it covers all of the closing costs as well. So your child could be a homeowner for $0. So that's how that works. So long as they meet all of the requirements, as far as like the debt to income ratio and all of that works. So gift of equity, just a flat out gift, or you being a non-occupying co-borrower to get onto the loan with the child. Maybe you make, $100,000, your kid is making 45. Well, now your kid can afford significantly more because of that income boost that you are providing by being on the loan. But when you do things like that, mom, dad, your stuff got to be in order. You just can't be like Hot Mess Express thinking you get ready to help them. We're going to look to see who has the lower credit score, and we're going to use that lower credit score. We're going to look to see, mom, dad, do you got $1,200 car payments, $1,000 car payments? Because of the debt that you have, it may not be helpful to your kid for you to get on the loan. So adults, mom and dad, please, 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 let's make sure that we got our stuff in order so we can try to have our kids in better situations too. Tamika Monique TV says, yes, I've heard of that. It's too late for my grandfather to give a gift of equity for his home with me. It is amazing. I'm trying to tell you, like, it's great. I think that if anybody could get a gift of equity, it's phenomenal. It's phenomenal because I mean it's your equity at that point. If you decide, you start kind of, again, still using my 23-year-old imaginary child. If that kid, decided, in a few years, hey, I'm gonna take this equity and I'm going to get an equity line of credit and I'm going to go put money down on an investment property. Now at 24, 25, 26, 27 years old, this child got 2 houses. And it goes and goes and goes and goes and goes. It is phenomenal. And it don't require you to save up any money. It just requires you to stay in your house, make on-time payments. Okay. And, sell the house to the child at an agreed upon amount to make sure that it is affordable to him or her. So it's cheaper to keep her. Oh, what was it, a divorce? Michael Mack. Hi, if I sell a car, would it be better to pay off my debt or put that money towards a property? I would need more context to be able to answer that. Because it's based upon what your goal is. Is it that there's a lack of assets for a down payment? Or is it that you would be freeing up money to afford more because of the debt to income ratio? Because those are very different things. If you are selling the car, sell the car to pay off my debt. So if you paid off the debt, what I'm hearing is if you're paying off the debt, it's because, you want to free up, $400, $500, $600 a month. That translates into almost $100,000 in purchase price or available loan amount. So indirectly, it would be going toward the purchase of a property. But if you take the profits, let's say you sell a car and you get $10,000, it'll be enough for a down payment, but it might not be enough for the down payment that you want for the house that you want. So I would have to kind of see what that scenario is exactly. The car would be worth $15,000. The payment would definitely reduce. Yeah. So then absolutely. Yeah. I mean, so long as you have additional funds to cover your down payment and cover your closing costs, because again, over here, I'm telling you, you can't get a house with no money. You gotta be prepared at least to go into a negotiating situation with your down payment and closing costs. And if someone decides they want to give you closing cost money, then that's great. But we want to make sure that we're able to cover the whole thing. So I think that would be great, because I guess I'll give an example. If the interest rate is 7%, $700 in freed up monthly debt, like for installment debt or credit card debt, would afford you another $100,000 in house. And so it could literally mean the difference between being able to buy or not buy. In my market, again, I am in Charlotte. We ain't got no $200,000 houses. And people are very reluctant to tell people that purchasing a $200,000 house is almost impossible because of what I alluded to a little bit earlier when I started talking about these institutional investors. They go in and they buy up the block. But yeah, I think that if you're able to reduce your debt, that's going to significantly change things for you, because reducing your debt does a lot more for you in purchase power than, oh, I want to put $15,000 extra down on my down payment. That does not move the needle as much as people think. The biggest way to move the needle to afford more house is the interest rate and the debt to income ratio. When you start talking about, oh, I want to increase my down payment, we're talking about loans that's amortized over 30 years. It's not like a car where it's like, oh, okay, I'm going to put, $3,000 down on this $15,000 car. I'm going to finance the car for 5 years. No. A couple of $1,000, like if you're talking about 300,000 and you want to add, another 15, it'll move the needle a little bit on your actual payment. But what really changes it is the interest rate. So might want to take that money to maybe buy your rate down, which that's another conversation in and of itself, because I'm not a fan of having people waste their money. Buying a rate down, it sounds great today. It sounds good. But if the interest rates go down, not even if, when the interest rates go down, you're going to forget that you spent an extra $4, $5, $6, $8,000 to save $100 a month. You're going to completely forget. And so buying the rate down is a good way to increase, like your affordability, and paying off debt is a great way to increase your affordability. So I hope that's helpful. I hope that answered your question. William Smith, and we still live in the house or move out? You move. If you want to live in the house, that's fine. You could sell the house if your child wants you to still live in the house. You're certainly welcome to. But in theory, it will be theirs. I've seen married couples, purchase their parents' home, gift of equity. Now they have a house to raise their kids in for, a while until they get a little more stable. But that would be completely up to you all. It's not a requirement because you would no longer be the owner. It has nothing to do with the possession of the property. It has nothing to do with, your if this is your primary residence or not. It has everything to do with who's responsible for that loan and, who's it deeded to at that time. But you're more than welcome to still live there. Absolutely. But again, in most cases, they might move out. Like I said, in my example, I was like, hey, I might want to keep $100,000. My $100,000 might be, okay, let me put some money down on my house. I might want to downsize houses at that time. And that would be a way for me to still use my equity, give him some equity, and me get another house. And we, kind of go our separate ways. Okay, perfect. Great. I'm glad that helped. All right, let's see. What time is it? Oh, yeah, it's 8:14. Oh my gosh, I went over my time. I had one more question I want to get. Okay, so this is the last one. And again, I'm happy to answer. If y'all have any more questions, please go ahead and put them in the chat. So I'm 6-8 months out from buying a home. How does applying for a credit card now hurt me? It doesn't. It doesn't. What we're concerned about is you using the credit card, not applying for the credit card. If you apply for a credit card because, you're at Best Buy and you want to buy a YouTube studio and you want a $2,000 computer and, $1,000 camera and, all these things, and you put it on the card, swipe, you have now automatically increased your debt to income, increased your debt to income ratio. And in doing so, you have likely caused your credit score to move because your credit score is tied to your credit utilization. So if you have $15,000 worth of credit card debt, worth of available credit. Let's say you have $15,000 in available credit and you go out and you like, well, I'm about this $5,000 worth of YouTube equipment. Okay, now you're at about 30% of utilization. But if you go out and you swiping, now we've added new minimum payments into your debt to income ratio. And we have now introduced a bigger problem because you might be at, 50, 60, 75% of your utilization. So that is going to cause your credit score to plummet in a lot of cases, because you are showing you can't manage what you got. I had this conversation recently with a couple. They're purchasing a home, and I mean, they got it going on, y'all. I saw the vision. Like I'm like, okay, we're gonna figure this out. Like I completely understood what the goal was. I understood the assignment. All right. I was like, okay, I'm trying to figure out like what can we do? How do I, finagle this, move this around? It's like a puzzle. And I love puzzles. It was like a puzzle. I was trying to figure out how do I make everything fit together. They had good credit. They had a decent amount of money. They had 401k. They wanted to purchase a house that was like $570,000. They currently owned a house. I'm with it. I love what we're doing. I'm right there with you. The debt to income ratio was okay. I could not figure out why when I was running everything through the automated underwriting system. So that's something I also want to drive home. Like whenever we're doing these approvals, it's not like oh, we don't like you, we're not giving you a loan. It is not it at all. The debt to income ratio, your credit score, how long you've been on your job, credit utilization, all of that stuff is evaluated electronically. It's fed through a system which is called the loan prospector or the desktop underwriter. It reads everything and it says, "Ooh, child, this is a mess. I don't think this is a good idea." And so it will give us back a finding that says approve ineligible or refer with caution or refer eligible. Those are actual statuses that we see. And so beneath that is a whole bunch of words that says, this is the problem, this is why. And sometimes it hints at what needs to be changed or what needs to be fixed. When I was running it through the desktop underwriter, I was like, wow, why won't this work? Like, what's the problem? Like, they had money, they the 401k, they paid everything on time. Like, what is going on? So I looked at the findings and it mentioned, that there was some issues with, credit cards. And so I looked at the actual credit report. And I mean, I'm going line by line. I'm like, okay, student loan. Oh my God, this is fine. Okay. What? And I came across the credit card. I clicked the button and I had them pay it off and everything was fine. The problem was because they were like, I don't want to pay off that credit card. Well, okay. Well, then, I mean, you have to. Like, that's the only way, because the system was reading the credit report and their credit profile. Like, hold on a minute. Y'all made like $15,000, $16,000, $17,000, $18,000 and you spending it all? Because think about it. Why else would you be using a credit card, right? So it's like, hold on. We got maxed out credit card. You make a lot of money. It was reading it like maybe they're already overextended. But as soon as I click the button, pay this off, smooth sailing. And I'm telling y'all, the house that they are getting is going to be amazing. They are a young couple and they are going to have 2 properties. So one is going to be the primary residence, like going to turn their current home into an investment property. And y'all, this is a house that they just bought in 2020. So they are on their way. They on their way. I love it. I absolutely love seeing people thrive. I'm telling you. But yeah, so they're using the equity line of credit too from the current home to be able to help fund the down payment and stuff for the new house. So you can't beat that. Perfect. Well, I'm so glad I could help. Excellent. 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 All right, y'all. This went over my time. I totally was like, I'm gonna be on for an hour. And look at me. It's like an hour and some change. Shout out. Oh my gosh. Shout out here trucking. Oh my gosh. I appreciate you. Cash out $50. He said, for love and support, I'll catch the replay. I appreciate you. Oh my gosh. Okay, so let me tell y'all, all right? And I hope he's still watching. Like, please still be watching when I say this. So, one, I need to make a stream sponsor. So next Tuesday, I'm gonna have him be my stream sponsor. Okay. So out here trucking, let me tell you. So as I was talking about, at the beginning, when I was like, oh, I got my YouTube channel, and people, they use it to get monetized and things like that. It is considered to be like another stream of revenue. And while you're kind of building your way up to that, sometimes people seeing cash apps and things like that to help, keep the channel going. And because this equipment, these lights ain't free. It's time to try to edit things. It's time to research things, all this thing. But I know most of this stuff, because it's my job. But y'all, the other day, last Tuesday, it was like my 3rd stream. So the first 2 live streams I did, I had to like recruit people, like, y'all come watch me, like, because I was so scared that nobody was gonna be listening to me. And it's all this like people from my YouTube mastermind that I mentioned a little bit earlier. And I'm like, oh my God, I'm so scared. So last week I was like, you know what? I'm gonna just throw caution to the wind. I'm gonna get on here, and I don't care if anybody watches me or not. Somebody's gonna hear me. I need to show up for the people that I need to show up for. And I had to like shift my perspective a little bit. Baby, when I tell you, I've been on other live streams before, because I have another channel with 2 other ladies. And we talk about something completely not related to mortgage. And I've, gotten cash. Okay, $75, whatever. Okay. When I tell you, when I saw that $50 cash out that came from Out Here Trucking last week, and it was on my channel by myself, I ain't never been so excited about $50 in my life. I'm trying to. It was so encouraging to me. Like, I was like, oh my God, I did that. So you have no idea how far that goes in terms of like boosting morale and making me want to step back in front of the camera again. And it's honestly because he was the very first person on my channel by myself to do that. And that was the first money I have ever made on the Mortgage Boss channel. I will never, ever, ever, ever forget him. Like, I will tell this story when I am 96 years old. Like, I was so excited about $50. That $50 meant the world to me. And this $50 means the world to me too. It's a big deal to me. It might not be a big deal to y'all, but those of you, if you're on here and you have a YouTube channel, you understand. Even if it's like some sort of business venture or something that you started and you didn't think, people would pay for, like, I don't know, maybe you did hair in college or something just for fun, and you know, somebody gave you like a $15 tip, you was probably like, oh my God, somebody paying me? Anyway, the point of the story is I was excited and I'm equally excited today. But I definitely wanted to express my sincere gratitude and excitement. Like, I wanted you to bask in this excitement with me about $50. It's nothing, but it's something. It's not a lot, but it's everything. So thank you, thank you, thank you, thank you, thank you. I mean, like, big, big deal. Thank you, Mr. CKB. See, he's in the YouTube mastermind as well. So he's a law student and he understands the struggle, because you get on here and you start talking and you like, am I talking to anybody? Is anybody out there? But the idea is not only somebody out there, is somebody listening, is somebody that is asking me questions back, is someone that appreciates my opinion and my knowledge, because I've been doing this for 8 years. I didn't fall off the turnip truck yesterday. I have been through some things. I have had a foreclosure. I have had bad credit. I have had to overcome things. I have, child, I don't want to talk about my student loan debt. I get it. I really, really, really get it. And to try to create a community of people, specifically people that look like me, that are interested in wealth building and attaining home ownership, and you come and you watch, you ask questions, and you watch my past videos. Because I saw y'all watching my last videos. I was like, oh, shoot. Like, they care. They really, really care about me and what I gotta say. Like, it means so, so much, especially because I love my job. I love my career. I have a passion for what it is that I'm doing, especially for people that listen and follow directions, y'all. This is not easy all the time. So I appreciate y'all sticking with me, supporting me. It encourages me to show up again and again and again, because it's somebody out there that hopefully, whatever it is I'm saying, whether it's about giving you the real on down payment assistance, or telling you it ain't no $200,000 houses, or telling you like, baby, you gonna have to make more money if you're gonna get a $400,000 house. All of those things, like, I might say it in a little bit of an unconventional manner, but I double dog dare you to go find somebody that knows what I know, because I'm very serious about my craft. I do this for real. My accredited mortgage professional designation, I spend time, energy, and effort on making sure that I am conveying accurate information to whoever it is that I'm talking about. Not, I don't be talking down to people. Like, when we converse about hundreds of thousands of dollars, I mean, I'm a key. Like, we're gonna laugh a little bit, but we're gonna have some for real come to Jesus talks if it's necessary as well. And we're gonna get you on a plan, and we're gonna get you a house, and you're gonna have your house, and you're gonna get you some equity, and you're gonna take your equity and you're gonna pass it down to your kids, and all of that, all of the things. Okay. Shout out to N. Allen. Hey, girl. Hey. She's actually my co-host. She's one of my 2 co-hosts on my other podcast channel. But you know, if you know, things get a little reckless over there. So just saying. I'm not good at having multiple personalities. So I'm exactly like this over there. But sometimes the topics might be a little spicy. Okay. So, hey, girl. She said, looking good. Thank you. I tried to wind my hair a little bit before I came on. So, you know, get a little curl action going on here. Thank you, thank you, thank you. She says, shout out to Mortgage Boss for keeping it 100. Great content. Thank you, doctor. Y'all, she's a pharmacist, okay? We over here, we building a community of high value women. You hear me? I love it. High value women and high value men, all with similar goals. We want to find ways to create wealth, not just for ourselves, but for our families and future generations to come. So I love that. Love it. Love it. Thank you for stopping by. So, y'all, I'm going to go ahead and end things. I'm available to, again, answer your questions. I have multiple videos if you are interested in other topics about like credit. I have some videos about credit. I do lots and lots of myth busting and thoroughly explaining things like why you can't get a house with a 580 credit score, even though they say that you can get a house with a 580 credit score. It's possible, but not probable. There are videos about things like that. There are videos about jumbo loans, VA loans for our veterans. You know, you can get $1 million loan with no money down. I actually created a short about how wonderful the VA loans are. I did that yesterday. No, I took a piece of the video from last week from the live stream and created a short to talk about that. So go go take a look at the live stream from last week because we cover a lot of questions there as well. And Alan has a question here before we go. She says, "What about refinancing a home after divorce?" You can, but you have to have some paperwork. If you are going to refinance, and this it's I'm gonna say two things. Okay, I'm gonna say one from a perspective of a married couple and one from a perspective of unmarried couple. If you are a married couple, that means you have some papers on somebody, which I thoroughly recommend. The judge will say, you know, hey, buy y'all, you know, split the equity, you know, buy if you're gonna stay in the house, hey, he can buy you out and you call me and I'll immediately say, hey, do you have a divorce decree? Do you have, you know, your separation papers? Like what do you have that you could provide to me in writing from someone of authority stating that this is what you're going to do? When we ask for a separation agreement or divorce decrees, we're looking for things like, are you required to pay alimony? Are you required to pay child support? Because those are things that we are going to look at to include in your debt to income ratio to determine whether or not you can sustain the mortgage payment moving forward. If you cannot, that's fine. However, the judge, well, not the judge, but the party that is leaving, so the exiting spouse that will not be living in the property, can do a quit claim deed, basically saying, all right, you got it, go off, sis, don't call me asking for no payments because it ain't my responsibility anymore. So they are relinquishing their rights to the property, and the judge is going to sign off, and whether you make those mortgage payments or not, this person can go off into their new life and ideally, you know, go buy a house or whatever. The problem is, if you don't refinance them off of the loan, we still gonna count that debt ratio, that into their debt ratio. But if for some reason you decide like you're not gonna make the payments or something like that, and the judge has made it, you know, the remaining party's responsibility, then we start kind of getting into like we can't hold that over the person. So there are a lot of things that are involved when you are married. Okay. Again, papers, formal papers, and a judge. Same type question when it comes to unmarried people. You ain't got no papers on nobody. What you gonna do? What are you gonna do? Who you gonna complain to? If it's a if boyfriend moves out and girlfriend is in the house and boyfriend is like, all right, I don't know you no more, don't call me, don't hit my line, I don't, you know, whatever, and you girlfriend is in the house and like, God, I'm struggling to make these payments. Well, you don't have a judge to step in to say, hey, it's so and so's responsibility. That's between the two of you. And so if you decide to obtain a property without knowing who you're getting into a property with, you may find that that person is willing to drag you and your credit down to a point where you can't recover from it. Yeah. So be careful when you are entering into financial agreements, such as purchasing a home with someone that you are not married to, because it can go real wrong real fast. And I've seen it. I remember I had a lady, she called and was like, hey, I want to refinance, because this was back like maybe 6-7 years ago. And I was looking at the loan information, because we serviced the loan at the time. And the lady, oh yeah, I was like, oh, this is great. You're gonna save like $300 a month. This is amazing. And so I'm looking and I said, well, who's so and so? Like, who's John? Like, John? Who's John? Okay, somebody's on the loan. His name is John. Girl, like, come on. Oh, my ex. Okay, yeah, where he at? Oh no, I ain't talked to him in years. Well, you better go find him. Okay. Again, that's why we need to have papers on people. So please, please, please be very, very, very conscientious of who you're entering in these legal agreements with, because purchasing a home is a legal transaction, and it holds the parties responsible that sign the papers on, yes, this promissory note, I agree to make these payments. It is equally your responsibility to make sure that that mortgage is paid on the first of the month, every month, henceforth and forevermore, until this house is sold. If the remaining person decides that they want to blow up their credit and it'd be a foreclosure, well, baby, guess what? You might be off with your new boo, but that is your foreclosure too. And that can impact you with whomever you're in relationship with and your ability to purchase a home with them. I remember, and I'll say this real quick and then I'll go. I had a lady. It was one of the very first people I talked to when I wasn't even a full loan officer. I was a junior loan officer, and I was on the phone with a lady, and I was calling her, and I was like, "Oh my God, you got like a 6.5 rate, and it's gonna be like 4.5. It's gonna be great." And she was like, "Yeah, this is good, this is good, this is good." And she said, "Well, wait, if I refinance, does that mean that my ex husband's not on the loan anymore?" I said, "Yeah." I said, "Yeah." I'm thinking, I'm telling her, yeah, girl. So that lady was like, "Oh no, I'm straight. I'm good. I want him to suffer, because that means that if he's off this loan, he could buy a house with his new wife. Ma'am, don't be that miserable, okay?" So it can go real bad. But if you are a married couple, divorce decree, separation agreement, who gets what, why, do you have alimony, do you pay, are you going to be paying child support, what are the agreed upon amounts, so we can include that in your debt to income ratio. If you're receiving the funds and you want to add that as a part of your income, we're going to need to see a history of you receiving it. So let's say, like in North Carolina, you have to be separated for 12 months before you can file for a divorce. So if you've been getting child support for like 8, 9, 10 months of, I don't know, I'm making this up, $1,200 a month, and you want to include that, you're more than welcome to, so long as the children the child or children will be receiving those monies for at least 36 months. So if you have a 8-year-old, 9-year-old, that kid ain't going nowhere no time soon. But if you have a child that is 14 and a half, you better hurry up, because when they hit 15, that's it. You won't be getting another 36 months. So, well, 16, 17. Yeah, you have 36 months. So as long as you're going to continue to receive monies for 36 months, that can be counted toward your income to help you qualify for that payment. That is the other thing. You have to qualify for the payment. If you are in a situation where you are divorcing and you guys start to get into the back and forth of, I got the kids and I want my kids to live in the house, and you can't afford that payment, you have to go. You have to go. If you can't support that payment on your own, you have to go. Unless that man is just a really nice person and he's like, okay, well, you know, I help out, whatever it is. But you have to go. You might have to downgrade your life. You have to go. So that's a big thing. Yeah, that's a big deal. So get some papers on some people. I know people are, recently engaged since what was it, Valentine's Day, but just make sure you know your people. A couple Thanksgivings ago, I had a couple. They were a week away from closing. Thanksgiving came. The lady called me right after Thanksgiving. I was on vacation. I'm like, I ain't answering this phone. Chaz, the lady was like, we broke up. No, if he want a house, he could buy it on his own. He was like, sure do, can and will. He could buy the house, bought the house, closed, got my commission. Life was great. Had they waited another week and a half till they had that falling out, they'd have both been on the hook. You cannot call the bank and just be like, hey, bank, I don't want this loan no more. Hey, bank, I moved. Hey, bank. Nope. You locked in. And you better be locked into somebody that got good credit and go make that payment. You better be locked in to somebody. Let me get off my soapbox. I'm just telling you some of the things that I do see. It can get real messy real fast. So, for gentlemen, last point, that are making the payments for child support and or alimony, those are considered installment payments. So whereas with the receiving party, because a man or a woman can pay alimony or child support, whoever is receiving it, they have a 3-year, like as long as you continue to get it for 3 years, we'll count it. For the person that is paying it out, we're going to continue to count that debt against you all the way up until you only have 10 payments left. So that child, if there's child support, if you're paying it out, we're going to count that $1,200 a month against you all the way up until that kid is 17 and 2 months, 17 years and 2 months. And that's granted that you live in a place where it's going to stop at 18, or, if it's June graduation or higher, because it changes from, state to state. So, all right, y'all. I appreciate y'all so much. I'm happy to answer questions. Let's keep the conversation going. Watch other videos about credit, income, asset information. My last live stream is available for you. You kind of scrub through it, see what interests you and what does not. And please reach out to me on Instagram. My Instagram is _mortgage_boss. I have a lot of conversations in real time through my stories. It's a good time over there. We laugh a lot. So y'all have a great evening. Thank you so much for spending time with me. I'll see y'all next Tuesday, 7 o'clock to 8 o'clock. Bye.